Welcome to my channel. I'm Scott, and in this video we're going to talk about valuation. These are the topics we're going to cover in this video: defining valuation, we're going to look at cash generating models, comparative models, what is a bond, because I think you need to understand what a simple bond is to really understand valuation. A simple loan calculation, valuing a stock part 1, part 2, what is WACC, and a summary. If you ask 10 people what valuation is, you may get a different answer from each person. It's pretty much the mathematical process of determining how much an asset is worth. There's pretty much two ways to value an asset. You could predict the future cash flows the asset will generate, or you can compare the asset to similar ones. Within these two concepts, there can be lots of variations in order to figure out the valuation of something. The first valuation is predicting the cash an asset will generate. So an easy way to understand this is think of bonds. When you buy a bond, you'll also get a fixed schedule of the principal and interest payments. It's similar to a mortgage. When you get a mortgage, you have a fixed schedule. That's why sometimes bonds are referred to as fixed income. You can also use a DCF model to predict the future cash flows of a stock. But the DCF doesn't work for every stock, but a lot of stocks it does. If you're looking to buy a small business, you'd want to know how much cash flow that business generates before you buy it. The other valuation technique, which is a lot simpler, the comparing method. For instance, if you want to buy a home or sell your home, you would just look at similar houses in that neighborhood and see how much they sold for, and that would be the value of your home. Because a primary residence isn't really a cash generating asset, so you can't use the first method. But if you were buying a rental property, then you probably could use the cash generating model. But if you're watching this video, I'm sure you compared stocks using the PE, price of sales, any of the price multiples. Lots of investors use both methods. They start with the comparing method, they compare the PE ratios, and then do a more deeper dive into predicting the future cash flows. As you can see, valuations are very quantitative, but they also involve a lot of assumptions. And we'll talk about these assumptions a little more as we get deeper into the presentation. So let's talk a little about cash generating models. This is when you try to find the intrinsic value of an investment. You can use lots of variables to figure this out, but the more common ones are dividends, cash flow, and sometimes you have to predict the growth rate. Because it's almost impossible to predict 20, 30 years in the future. So at some point you have to stop and just apply a consistent growth rate. So two really common examples of these models are the dividend discount model and the DCF, discounted cash flow model. If the company does not pay a dividend, you can't use the dividend discount model. And if the company pays a really small portion of their earnings out as dividends, then a DCF may be better. But if a company pays a big chunk of their earnings out as dividends, like a REIT does, then this may be the better model to use. When you use a comparative model, you're comparing similar stocks to each other. And the most common comparative tools are the PE, price to sales, price to book, and price to free cash flow. But there's also many more. When you compare stocks, you want to compare similar stocks. You don't want to compare Meta to Kraft Heinz. Maybe you'd compare Coke to Pepsi, and if Coke has a lower PE, then Coke is more undervalued than Pepsi, at least according to the PE ratio. But if you were looking at a bank or an insurance company, or a company with lots of fixed assets, then maybe it's best to use the asset-based valuation approach. This is when you sum up all the assets on the balance sheet, then subtract the liabilities. But you want to be careful because the assets on the balance sheet may not be the amount of money you can get the asset for. If a company has $1 billion of cash and no liabilities, then you could safely say the company is worth $1 billion. If another company has $1 billion of receivables and no liabilities, you can't safely say it's worth $1 billion because there's no guarantee they can collect the entire $1 billion. As you can tell, comparative models are much easier and quicker to use. That's why a lot of people start with comparative models and then maybe use the discounted cash flow model. But most investors just use comparative. They don't use anything else. I think it's really important to understand how a bond works, because once you understand the dynamics of a bond, I think a DCF makes a lot more sense. A bond is a loan made by an investor to a borrower, similar to a car loan. If you needed to buy a car, you may go to a bank and ask to borrow $30,000. So you'd be the borrower and the bank would be the investor. And the bank would charge you an appropriate interest rate for the loan. You could think of it as an IOU between a lender and receiver. A bond has predetermined fixed principal and interest payments. Because there's no guaranteed future payments on a stock. Even if a stock pays a dividend, there's no guarantee they will keep paying that dividend. But a bond is guaranteed. The only risk for a bond is the lender defaults. But if the lender doesn't default, you're pretty much guaranteed your payments in the future. So a bond can be structured many different ways. They can have monthly principal and interest payments of $1,000 for the next 36 months. They can do something closer to a balloon payment where they have really small payments of $500 for the next 9 years, then a lump sum at the end of $10,000. A bond can pay quarterly P&I payments over 3 years or 12 quarters. The first quarter they can pay $2,000, then the next quarter $1,900, and it declines each quarter. But all the terms for the bond are preset in the bond indenture. And bonds are used by really big companies like Apple or really small microcap companies. Cities, towns, states, sovereign governments, they all use bonds. How do you think hospitals and schools and railroads and highways get built? Generally by bonds. And I've heard people say, how can the state of California go bankrupt? I heard they went bankrupt at one point. It's the same way as a company goes bankrupt. They default on their bond payments. Pretty much the definition of bankruptcy is defaulting on your bond payment. The same way you go bankrupt. If you stop paying your mortgage, you may be forced into bankruptcy. If you're 30 days late on your mortgage, the bank won't force you into bankruptcy. They'll call you or send you a letter asking for payment. And then if you realize your credit card expired and you forgot to change your card with the bank, then it's no problem. You give them the new card and you pay your mortgage. But if it's 6 months and you still didn't pay your mortgage, then the bank may force you into bankruptcy, take your home and sell it. Let's analyze some simple loans and calculate the return. Remember, a loan is really similar to a bond, and we can use the same approach when we analyze stocks. So let's say you loan your friend Mike $100, and you require him to pay you $110 after 1 year. So your profit on the investment is $10. So your return is $10, and the original investment was $100. So your return on investment is 10%. To be really specific, it's probably between 9.5% and 10%, because money loses value over time. So when Mike pays you $110 a year from now, you can't buy as much goods and services as you could when you originally lent him the money. Let me give you a better example to explain why the interest rate will go down. Say you lent Mike $100 today, and he gave you $110 in 50 years. Would you still say it's a 10% return on investment? No, of course not. You actually lost money because you can't buy that much for $110 in 50 years as you could today. But just for argument's sake, let's keep it at 10%. We won't do any discounting. Let's make it really simple. I'm just trying to convey the point on how to calculate the return on investment. But in a couple of slides, when we do a more in-depth DCF valuation on a stock, then we will do discounting. Say for loan 2, you give Nancy $50 and she pays you $60 after 1 year. So the same thing, you have a $10 return on your investment, but it only cost you $50. So your ROI is 10%. So why don't you just always loan money to Nancy? Why ever loan money to Mike? You get such a better return with Nancy. Well, you're an investment banker and you did a lot of analysis to come up with 20% for Nancy and 10% for Mike. Hopefully you didn't make it an arbitrary decision saying, I'm going to charge Nancy 20% because she's my ex-girlfriend and I don't like her. And I charge Mike 10% because he's my buddy since college. Let's say you did a full credit analysis and the reason you're charging Nancy more than Mike is because Nancy makes less money than Mike. She tends to pay back her loans later than Mike, and she has more debt than Mike. She has credit card debt. Mike only has a little debt on his home. But really the point of this slide is to calculate the return on the investment just to see how it works. Let's apply the same concept to a stock. Let's value a stock using the same idea as we did in the last slide. Say there's a stock trading at $100 per share. And let's say in the past 12 months their free cash flow is $10 billion. Because for most stocks, free cash flow is the cash that's remaining for the investor. And you could argue there may be better approaches than free cash flow, but let's just try to keep it simple. I think free cash flow is a good way to start. And let's pretend the company has 1 billion shares outstanding. So the free cash flow per share is $10. So that's your return on investment, $10, and you invested $100. So you have a 10% return. If the company paid out 100% of their free cash flow in the form of a dividend, then you would get your return in cash. But if the company does not pay a dividend, they reinvest it back into the firm, then your 10% would be in the form of an increasing stock price. The stock price should go up 10%. And I know the stock market could go up a ton, it could go down a ton. It's really volatile. But over time, fundamentals should prevail. Now, if a company has negative free cash flow or really low free cash flow, then this doesn't really work. You'd have to estimate the future free cash flows. This approach is good for a company that's been around a long time that has positive and consistent numbers. But as we know, most companies don't have positive and consistent numbers. So we might have to use a more aggressive approach we'll do in the next slide. Now let's value a stock where we need to predict the future cash flows. Say a stock has a market cap of $10 billion. And let's say they have negative free cash flow currently. If we never see a point they have positive free cash flow, then we probably shouldn't invest in the company or maybe short it. Let's say we do a bunch of due diligence and we predict their free cash flow in 2023 to be negative 10 million, 2024 negative 3 million, then positive 150 million, and then in 2026 1.5 billion. And then at that point, we can give them a consistent growth rate of say 2.5%. Maybe this is a new EV company and they really haven't sold much cars yet, but we feel by 2026 they're going to hit their peak and they're going to be in much more demand at that point. So it's really hard to predict cash flows for the next 10, 20, 30 years. So that's why DCF models use a terminal value. It predicts all the cash flows after a certain point. So if we predict all the cash flows after 2027, we're getting $21 billion. And the way you calculate the terminal value, you take the prior year free cash flow, 1.5 billion, you multiply by 1 plus a growth rate. You can use any growth rate you want. I use 2.5%. Then you divide by the WACC. We gave them a WACC of 9.8% minus the growth rate. The WACC is the weighted average cost of capital. It's how much it costs the company to obtain capital through debt and equity financing. We'll talk more about WACC on the next slide. So we need to apply a discount rate because we have to present value the dollars into today's numbers. So 2023's discount rate will be 1 plus the WACC raised to the first power, so 1.098. So we have to divide the free cash flow in 2023 by 1.098. 2024's discount rate will be 1 plus the WACC to the second power, 1.206. Then 1 plus the WACC to the third power to the fourth power, and we use the same discount rate in the terminal value, 1.453. So when we discount the future free cash flows, we get 15.6 billion. And the company's trading at 10 billion, so we see a 50% upside. So this may be a good opportunity to buy the stock at a discount. Even if you identified an undervalued stock, it could take years and years for the rest of the market to figure that out. So you may not make any money even if you do a lot of good work. You also may make a lot of money by making a mistake. Say you think a stock is really undervalued and it does go up a ton, and you sell the stock at an 80% profit, and then the company goes bankrupt. It turns out to be a Ponzi scheme. You just got really lucky you sold before it crashed. But generally, if you do a lot of work, you'll be rewarded and you learn a lot more. But you see, we have to make a lot of assumptions. We have to assume the future free cash flows, and sometimes a company will provide this to you, but that doesn't mean it's going to be accurate. We also have to assume a growth rate, and a really difficult number to figure out is the WACC. The WACC is how much it costs a company to obtain debt and equity financing. It's also referred to as the hurdle rate that investors use to decide whether to take on a project or acquisition. To give you an example, say there was a house across the street that you wanted to buy, but as a rental property, as an investment, and the bank's going to give you a loan at a 5% interest rate. That's your hurdle rate, 5%. You have to look at the money you got to charge the renter for the property, you have to minus the expenses, and say your return is going to be 4%, it's going to be lower than the hurdle rate, then maybe you don't want to buy the house. But if the return is going to be 10%, then maybe it's a good investment. The way you calculate the WACC, you have to figure out the cost of debt, which is pretty easy. It's just the interest rate on the debt minus your tax savings. Then infinitely more difficult is to figure out the cost of equity. And then after you do that, say the company's 80% equity, 20% debt. You multiply the cost of equity by 80%, the cost of debt by 20%, you sum those numbers together and you get the WACC. And like in the last slide, people use it as a discount rate for DCF models. So to summarize, it's pretty complex to value a business. If it's a small business in your neighborhood, it might be a lot easier than a large entity like Microsoft. And valuations are really subjective, which is why some analysts are wildly different from other analysts. And the reason they're so different is because of all the assumptions. If one analyst is being sponsored by GE, then I have a pretty good feeling their forecast on GE is going to be pretty high. Because no matter how much we try to avoid it, we're all hardwired to have opinions and viewpoints. And a lot of times it's subconscious. But let's just say you were doing a valuation for JP Morgan Chase. And 10 years ago, your Chase account got hacked into, you lost $10,000, and Chase would not reimburse you. So you had to close down your Chase account, open up a new bank account, and connect that new bank account with all the companies that you pay. It's a big headache, plus you lost $10,000. I have a feeling your valuation on JP Morgan Chase will be a lot lower due to that incident. And let's say you went to a friend's birthday party, you got really drunk, had a good time, you took an Uber, and you went home. The next morning you couldn't find your phone, so you contacted your friend said that your phone's not here, you look all over your house, you can't find the phone, your doorbell rings, it's the Uber driver giving back your phone, you left it in his car. Stuff like that will give you a better valuation on Uber. Even if you think you're separating that incident from your valuation, subconsciously you're going to find better things in your Uber valuation and ignore some negative things. But these are two obvious instances. All the time I go into a store and for some reason I buy certain products and I'm not confident they're better than other products, I'm just used to it and I always buy those. So you have to take that into account when you do a valuation. A valuation is not the end-all be-all. You want to combine it with other due diligence to make up your decision. And the more info and data you can obtain, the better investor you can be. I hope you learned something new in this video. Please leave a like, subscribe, comment. Talk to you soon.